Hi class. In this video we're going to look at a few examples from chapter 22. So we're talking about bonds payable. And we're not going to look at all of these, but I picked out a few that I thought might give you some trouble or that really represented the majority of what we're going over in this chapter. So let's look at number 4. We'll look at number 5, number 6, and finally at number 9. So 4 says Court Incorporated was authorized to issue $1 million of 10% bonds. They issued bonds with a face value of $220 at a price of $102.4. They're 10-year bonds, and interest is payable semi-annually. So we are to prepare the journal entry to record the April 1st bond issue. All right, so to do that, we know they're selling bonds, they're getting cash. We need to debit cash because they got cash, but we don't quite know how much until we do some calculations. So this says, oh come on, scroll up. It says they issued $220,000 worth of bonds at 102.4. So essentially what that means is they issued $220,000 worth of bonds at a percent of 102.4% of their value. So if we take the $220,000 and multiply that by 102.4%, or you can do it by 1.024, same thing, either way it'll work, it tells you that we actually got paid $225,280. So that's the amount of cash that we receive. We're going to record bonds payable. If I can find it. There we go. Because at some point we're going to have to pay these bonds back, and we're going to pay the bonds back at whatever it says on the face of the bonds. So it's the face value of the bonds, which was $220,000. So obviously we have a problem here because our debits and credits are not in balance. So we're going to put in a plug number to balance our entry, and that plug goes to premium on bonds payable. Now it's a premium on bonds payable because we actually were paid a greater amount than what the bonds say on them. So we were paid more cash than what the bonds actually were supposed to be worth. And that is a credit. If we were paid less, then it would be a discount, and this number here would be over here under the debit. So debit is discount, credit is premium. So let me make sure I did my math right. All right, so number 4 is complete. Well, let's look at number 5. It says court was authorized to issue $1 million of 12% bonds. They issued bonds with a face value of $190,000 at a price of $102.0. 10-year bonds, and interest is payable semi-annually. So this says what amount of premium will be amortized by court on October the 1st using straight line amortization. So first of all, we have to figure out how much was the premium to start with. So let's open up a spreadsheet just so I can kind of work through this. All right, so we have $190,000 worth of bonds sold at 102.0. So here's our bonds, 190,000. The premium of our bonds was 190,000 times 102%. Let's make this in a currency so we can see it a little better. All right, so our face value of the bonds and the bonds that the amount that we actually got, there's a difference. So the premium on the bonds is the difference between the two. So we have $3,800, that's the premium on the bond, and that's the total premium. Now we're going to amortize that, so let's go back over here to our instructions. They're 10-year bonds, and we're looking at one amortization, which is half a year, 6 months. So to figure this out, we've got a premium on bonds payable. So the amortization per year would be the $3,800 divided by 10 years. because they're 10-year bonds. So if we had $380 for a year's worth of amortization, we would just divide that by half to get 6 months, because we're looking at a 6-month entry. So let's go back over here. So the amortization of the premium for 6 months is $190. Let me make sure I did my math right. And it likes that, but it says it's not complete because we haven't done the second tab. So we're recording the amortization. So when we recorded the premium, we would have credited premium for the full amount, which was what, $5,080 or $3,800. $3,800 was the full premium. So when we sold those, we would have credited the premium on bonds payable for $3,800. So as we amortize, essentially what we're doing is decreasing that amortization over time until eventually it's going to be zeroed out. So we're going to debit premium on bonds payable because we're just essentially undoing that entry. We're just doing it step by step over a period of time. And let's see, bond interest expense. So the other half of that entry goes to bond interest expense, because essentially the effect that a premium has, the overall effect decreases the actual interest expense that we are paying. So if this was a discount that we were amortizing, this entry would look the opposite way. We would be debiting bond interest expense and crediting discount on bonds payable. But this one actually will look like that. So let's see if I did my math right. And so that's all there is to number 5. So let's go to number 6. We still have bonds. We issued $180,000 worth of bonds at 101.4, still 10-year bonds, and still interest payable semi-annually. So using the data given, give the adjusting entry. So we are doing an adjusting entry on December 31st. So watch your dates on these because it'll trip you up. So we're recording the accrual of interest and amortization of the premium for 3 months. So we're not actually paying anything. We are just doing that adjusting entry. So let's start with bond interest expense. Oops. So the bond interest expense, and this is for 3 months, so the bond interest expense is calculated at the face value of the bond. So it's $180,000 times 8% times whatever period of time it is. So this is 3 months. So let's see, 180,000 times 8%, and then that's $14,400 times 3/12. It's $3,600. So that's the bond interest expense. That is actually the face value of the bonds. Now we're going to calculate the premium that we're going to amortize. So the premium, let's use our little spreadsheet again. So we have $180,000 worth of bonds. And let's see, they were sold at 101.4. So we're going to take the 180,000 times 1.014 or 101.4%. Gives you a bonds at a premium of $182,520. So the premium on those is actually $2,520. Those are 10-year bonds. So if we divide that by 10, we get an annual amortization of $252. However, we're only working with 3 months. So we need only a fourth of that. So 252 divided by 4 is $63. That's the actual amortization for 3 months. So if you remember, when we record premium on bonds payable, we credit it. So to amortize it, we're going to debit premium on bonds payable. Now usually when we amortize premium on bonds payable, we record a premium on bonds payable as a debit and interest expense as a credit. So that interest expense that we would have put here would be $63 in that bond interest premium. Bond interest expense. And then the last thing we would do would be to record the actual bond interest expense that we're paying, and that's just the face value of the bond times whatever the rate is, which I think was 8%. So we would do 180,000 times 8% times 3/12, which would give us $3,600, and that's the actual interest payable. All right, so this is not going to like this because I have a bond interest expense credit here and a bond interest expense debit there. So I have the same account that I'm debiting and crediting. So I believe that Connect's going to require us to lump those two together. So let's see. If we were to combine this bond interest expense with that bond interest expense, we actually get a debit of $3,537, which means I can get rid of that. So I'm going to move my bond interest payable up. That one goes away. So hopefully that made sense. I just consolidated those two bond interest payables. I didn't change anything else, so let's see if it likes my calculations. And it does. Hallelujah. It's a good thing. And so number 6 is correct. So let's look over at number 9. Number 9 says Dave's Deli issued 53,000 of its 10% bonds and matures 10 years later. Interest is payable semi-annually. The issue price was 88, so these bonds are actually getting issued at 88% of the face value. So that should tell us that we're issuing these at a discount. They're retiring the bonds in 2022, so it's nowhere near the 10 years. 3 years and 4 months after the bonds were actually issued. Bonds are repurchased at 93, and we are recording the accrued interest expense payable through, we already recorded the accrued interest expense payable through August the 22nd. We've got a balance on the discounted bonds payable of $4,240. All right. So let's see, we're preparing the journal entry to record the repurchase and retirement of the bonds. So we know we're repurchasing bonds payable, so let's go ahead and plug that in there. And that's going to be a debit because it was a credit to start with, so we're going to debit that amount out. And let's see. We have some cash that we're getting paid. We've got a discount that we need to get rid of. And we're going to have a gain or a loss. We don't know that yet. So I'm going to skip a line for our gain or loss, whichever the case may be. We know we're paying out some cash, so we can go ahead and plug that in there. And we know we have a discount that we need to get off the books. All right. So the bonds payable that we're getting off the books, we're recording that at just the face value of the bonds because that's how much we put it in there. So when we sold these bonds, let's see. When we sold these bonds, we sold them for $53,000. Or that was the face value. We didn't sell them for $53,000, but that's the face value that was written on the bonds. So we sold $53,000 worth of bonds, and we put that as a credit in our bonds payable. So we're going to debit that. And that's going to get those bonds payable off of the liability part of our income statement. We have a discount on bonds payable that we need to get off the books as well, and it told us what that was. $4,240. So we're going to put that in here, $4,240. That's a credit because a discount normally carries a debit balance. We're removing it from the books, so we're going to credit it. And let's see. The bonds were repurchased at 93. So we've got $53,000 worth of bonds repurchased at 93%, which is $49,290. So that's actually how much cash we are paying out. So that's just the face value of the bonds times the percent that were the issue price of the percent. Oh, that was the issue price. Repurchase at 93, so we're going to use that. All right, so now let's see. We have debits of $53,000 and credits of $49,290 and $42,440, which gives us credits of $53,530. So we're out of balance. We've got $53,530 over here and $53,000 over here. So we need $530 in the debits to bring us into balance. Since it's a debit, we should know that's a loss. Loss on early retirement of bonds. If it was a credit, it would be a gain on early retirement of bonds. Let's see. Let's check our work and see if I did my math right. Huh, yay! So we've got bonds payable and loss on early retirement is our debits, and cash and a discount are our credits. So we paid cash and we got rid of that discount, and all of that was actually more than the amount of our bonds payable. So we have to do that plug number. If these credits were less, then we would have a credit in this second line, and it would say it was a gain on early retirement of bonds. So it could be a gain or a loss. This one just happens to be a loss. And I think that's all there is to number 9, I believe. Yep, no more questions. So that's how you do number 9. Hopefully this will help you as you work through the homework. If you get stuck on anything, just send me an email, give me a call, and I'm happy to help.